When it comes to building wealth through investing, dividends often play a crucial role that many investors underestimate, overlook, or don't really fully understand. But in this video, we're going to go over one of the biggest cheat codes when it comes to dividend investing and how this one simple metric can completely change the long-term outcome for your dividend growth portfolio. Now, this is important, so make sure to stick around, drop a like down below, and subscribe. Now, let's get into it. Now, when it comes to dividend investing, for the most part, most dividend investors look at things like how much is the stock or ETF yielding on a trailing 12-month or forward basis. For this example, the SCHD ETF or the Schwab US Dividend Equity ETF currently has around a 3.71% trailing 12-month dividend yield, which is definitely an important metric to pay attention to. Now, with that yield, this is offering around $2.62 per share. So every share of SCHD in theory that you purchase for $71.01 per share, you as an investor are going to get paid out $2.62 per year. Now, SCHD pays out a dividend on a quarterly basis. Keep in mind, some stocks and some ETFs do pay out dividends on a different frequency, such as monthly. But for SCHD, you are going to get paid 4 times per year, somewhere of around $2.62 divided by 4, which equals around 65 cents or so. So now you might be asking, well, that's great. What exactly is the so-called cheat code when it comes to dividend growth investing? What in the world is this metric? So the cheat code or metric we're talking about is none other than dividend growth rate. The dividend growth rate is an annualized percentage rate of growth that a particular stock or ETF's dividend undergoes compared to the 12-month period before that. So let me give you a quick example. If in fact SCHD, for example, paid out $1 in dividends last year, and now this year, let's say it paid out $2 in dividends, that would be a 100% growth rate. Or in simple terms, your dividend would be doubled year over year. Now, over time, you're going to realize that a lot of different stocks across the market, as well as ETFs, have a dividend growth rate of somewhere of around maybe 1, 2, 3, maybe 4 or 5%. And I would say personally, a good rule of thumb is anything that has a long-term dividend growth rate north of 5% is definitely something that should get your attention. So the reason on why I think that dividend growth rate, that simple metric, is such a cheat code when it comes to long-term dividend growth investing is simply because of this right here. If you look at this graph right here of every single dividend payment on a quarterly basis that the SCHD ETF, for example, has paid since the inception of the ETF, you can see one thing that's very specific. Over time, the SCHD ETF has paid more and more in dividends on a quarterly basis at a pretty impressive rate. Now, to give you a visual example of an ETF that does not have dividend growth, just to show you how it looks, the QYLD, the Global NASDAQ 100 Covered Call ETF, has been paying dividends on a monthly basis for quite some time. And here's every single monthly dividend that this ETF has paid since the inception of the fund. Now, if you go back in time in 2014, this fund was paying around 19 cents per month per share, 21, 26, and pretty much everything else in between. Now, around 10 or so years later, this ETF is paying around 16 cents per share, 17 cents, 18 cents per share. Now, keep in mind, this ETF has an entirely different strategy, and I'm not saying that this ETF in any way is even comparable to that of something like SCHD. But just to give an example, a visual of what a lack of dividend growth looks like, this is what it looks like right here. So now going back to SCHD and looking at the dividend growth as far as dividends paid historically, the reason on why this metric is a cheat code, it's basically giving you as an investor a raise for doing absolutely nothing on your same exact shares of SCHD over time consistently as the years go on. Now, why is this important? Think about it the same way like it's your job. If you started working somewhere at 2014, and then in 2015 you got a 15% raise year over year, you'd be pretty excited. Let's say you make $20 an hour and you get a 15% raise. Now you're making $23 an hour. Now that you're making $23 an hour, let's say another few years go by, and now you're making, let's say, $26 per hour, just in a few year time frame. Now, the reason I like to use the job example is because this is just like getting raises at your job. Only the difference is that you're not doing anything. You're not clocking in a single second. You are just owning an asset, owning a stock or owning an ETF. Again, for this simple example, it's the SCHD ETF. But you're owning something that is considerably paying you more and more over time just for maintaining ownership. Now, the reason that dividend growth is so important is because with this, you can see the snowball effect really to take shape in your portfolio. If you own, say, 10, 20, 100 of a stock or ETF that's consistently paying you more and more as the years go on, you are going to start to see the power of compound interest take place. Now, compound interest is the interest you earn on interest. This can be illustrated using basic math. Like, for example, if you have $100 and it earns 5% per year, At the end of that year, you'll have $105, and then by the second year, if you earn 5% on that, the numbers are going to get bigger and bigger as the numbers get bigger and bigger. Now, for the more visual learners out there, you are going to love this. Say you have $100,000 invested into something like the SCHD ETF, which we went through earlier. You then add another $1,200 per year towards more shares of SCHD. You get paid out on a quarterly frequency, and you are going to reinvest all the dividends back in. Now, on top of that, SCHD is offering a starting dividend yield of around 3.9% and an 8% expected annual dividend amount increase. So this right here is going to be your dividend growth, 8%, let's just say, for this example. Now, on top of that, a 3% expected annual share price appreciation, and then 20 years invested. Let's see what we get. So as you can see right off the bat, before we go through the numbers, you can see that the compound interest is really taking place by just looking at the shape of the graph. So the way this works is then simple. The $100,000 the first year would earn you around $3,900 off the starting yield around 3.9%, and this would bring you to around $107,000 by year number 2. But remember, now you are going to earn more interest off this number because the amount of interest that you're earning on an annual basis is now moving up. Because of course, dividend growth and the power of compounding is happening right before our eyes. So as you go through the next 20 years or so, you're going to see the numbers get bigger and bigger, and as the numbers get larger, they start to just really have a mind of their own, and they just really get large. You can see that a $100,000 principal initially, with $3,900 in annual dividends, quickly turns into big money. By year number 10, $200,000 invested and over $12,000 in dividends, just 10 years in. And this is just off of $100,000 invested, keep in mind. Now, 20 years in, all the way at the bottom, $516,000 and $51,000 plus in annual dividends. And this only happened because, for this one example, we used an example of a dividend growth ETF that does historically have a nice, fast annual dividend amount increase, or fast dividend growth. Now, for example, if we were to change the expected annual dividend amount increase to 1 instead of 8%, the outcome is going to look so different. You can see right here the power of compounding does not necessarily kick in like it would have otherwise. And you can see this by after year number 1, the same amount of dividends more or less is being paid off of the original principal, but very quickly on you're going to notice that the amount of dividends annually is going to shrink like crazy. If we were to shrink the amount of dividend growth that this ETF or stock, for example, would be offering per year. So when it comes to investing for a long-term portfolio, definitely pay close attention to what these different stocks and or ETFs are offering as far as historical dividend growth rates. Because I can't speak for everyone, but for an investment that's willing to pay me more and more over time, that's an investment that I want to be a part of. But when it comes to long-term investing, building out a long-term dividend growth portfolio, if you had to pick the number one most important thing of all, what exactly would that be? Comment it down below. If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.